Dear investors, as we head into the second half of the year, financial markets continue to demonstrate heightened volatility. We discussed previously some of the reasons for this, namely the Ukraine conflict, supply chain issues stemming from COVID lockdowns, and pent-up demand for goods and services arising from the quantitative easing that was conducted by central banks in 2020 and 2021. These have all been contributing factors in inflation persisting for longer than most economists have predicted. In June, CPI, which is a measure of inflation, exceeded expectations, hitting 9.4% in the UK and 9.1% in the US. This has led to the recent rate rises we have seen of 0.75% and 0.5% from the Federal Reserve and Bank of England, respectively. Both equity and bond markets remain incredibly sensitive to any major economic data releases. July saw a broad recovery across equity markets, with the FTSE 100, S&P 500, and NASDAQ indices rising 3.7%, 6.6%, and 10.2%, respectively. Whilst we welcome the positive numbers, we are still very cautious that this is a fragile short-term bounce and not substantiated with convincing amounts of positive economic data. We expect to see some downside later this year, unfortunately, as inflationary pressures hit consumer discretionary spending and company earnings for those businesses that cannot pass on their costs. To this extent, we believe the risk is still to the downside and therefore hold a much larger percentage of cash across all of our client portfolios at our strategic levels. We expect to continue holding this level of cash until we start to see stability and an eventual decrease in the inflation data. Suffice to say, no investment rises continuously without interruption. History teaches us that financial markets are incredibly resilient and are able to adjust and recover over a period of time. This 20-year graph of the US S&P 500 index just goes to show how stock markets have been able to recover throughout many headwinds over time, like bubbles, wars, political issues, and even a pandemic, as we saw in 2020. So, where are the silver linings in the economy? There are signs that some of the inputs that contribute to inflation are subsiding. Unemployment data remains robust, shipping costs are reducing, and Chinese exports are back on the rise. And the Purchasing Managers Index, PMI, which is a sign of the confidence of business leaders about the future of business, still remains positive. Whilst all of these numbers are not quite where we would like them to be for a resounding, broad-based recovery, the green shoots are certainly starting to appear. Whilst the year still holds many hurdles, we are at least seeing some clarity on the risks. We are using this information to position our client portfolios accordingly to navigate these tricky financial markets. Our last portfolio purchase decisions added a market-neutral fund and 2 commercial property REITs. These have performed as we expected. The investment team continues to review changes to your portfolio to reflect the economic environment, accounting for risks and seeking to take advantage of opportunities that may arise. As always, we encourage you to contact your financial advisor should you have any immediate concerns. If you have further questions for us, we of course welcome them and ask our clients to contact us on the email on the bottom of the screen.